The CPI inflation, which was released a couple of weeks ago, and it was a complete disaster. The rate of inflation was 8.3% in August. The CPI rate for September was not released yet, and once it's out, I'll keep you updated. Here's the CPI inflation rates for the previous months. For June, 9.1%. For July, 8.5%. August, 8.3%. Inflation came down 0.2%. I'll explain why the inflation came down. It's because the gasoline prices plummeted in August, and this helped to bring down inflation 0.2%. Gasoline prices declined 10.6% from July, according to the CPI report. The national average price of regular gasoline is now $3.71 a gallon, down 26% from the peak in June, according to an Energy Data and Analytics report. As I explained in my previous video, the gasoline prices came down because the government's releasing oil from our Strategic Petroleum Reserve. The sole purpose of doing this was to lower gas prices. We've been releasing little above 1 million barrels of oil a day and will continue to do so until October 31st, which is just 8 days prior to the midterm elections. We're currently producing 12 million barrels per day, so 1 million barrels of oil from our Strategic Petroleum Reserve is good enough to manipulate the economics of our oil market. That decrease in the oil prices resulted in 0.2% decrease in the CPI rate. However, you need to understand that this manipulation is temporary. The Strategic Petroleum Reserve, which is supposed to be used in emergencies such as natural disasters or other emergencies, but our current administration is using it for their own benefits. You need to understand that once we stop releasing oil from our Strategic Petroleum Reserve, oil prices are expected to shoot up for the rest of the year. That's actually going to make inflation worse. Also, the Fed's plan is becoming ineffective, and this is a big problem for our economy in general. When I say economy, it's the housing market, the stock market, the crypto market, everything. When you look at core inflation, when you exclude food and energy prices, core inflation went up in August from the year earlier. Core inflation was 5.9% in both June and July, and it went up 6.3% in August. The price of food is up 13.5% since last year, and this is the largest increase since 1979. Rent's up 6.7%, the largest increase since 1986, but we all know that 6.7% rate is government figure, and we all know that the actual number is a lot higher. Even if we go by the government figure, the number is still the largest since 1986. Electricity's up 15.8%, the highest jump since 1981. Health insurance is up 24.3%. This is the largest increase ever. The acceleration in inflation last month clinches the case for the Fed to lift interest rates by at least 0.75 percentage points at its next meeting and raises the prospect of hefty increases continuing in coming months. Fed Chairman Jerome Powell said in late August that while rate increases would bring down inflation, they'll also bring some pain to households and businesses. But the Fed's rate hike is not bringing down inflation, so the Fed's game plan is clearly not working. The average household is spending $460 more each month to buy the same basket of goods and services as last year, according to reports. That's a big burden, particularly on lower-income households. On a monthly basis, prices rose for more items tracked by the CPI in August than in July. Food prices continued to climb sharply this past month, rising 0.8% in August from July, as did those for new vehicles. Prices also rose last month for medical care, education, electricity, and natural gas. One key channel of inflation is rising housing costs, which rose 0.7% in August from July. These costs account for nearly 1/3 of the overall CPI. Once housing costs start to rise, that momentum tends to persist. So why this rate of inflation report so important? Investors and policymakers follow core inflation closely as a reflection of broad underlying inflation and as a predictor of future inflation. With this report, the Federal Reserve will decide what to do next. Depending on the inflation rate, they'll decide to increase the interest by 0.25% or 0.5% or 0.75%. We all know that the Fed increased the rate by 0.75% on September 21st. As the Federal Reserve continues to raise the interest rates and they continue with their quantitative tightening, here's what's going to happen. First, it's going to hurt the real estate market. The mortgage rate will continue to rise. The current rate is already at 6%, and if it continues to go up, home affordability will be even worse and the demand for homes will decrease because less people will afford such high rates. Less demand means there's going to be a further slowdown in the housing markets. As per the current trend, the Federal Reserve is going to raise interest rates on November 2nd, as well as December 14th again. This will in turn put pressure on the debt market, the housing market, the stock market, and even the crypto market. Rising interest rates and tightening economic environment, it's going to slow down the economy. This was confirmed by Fed Chairman Jerome Powell. During the July FOMC meeting, Powell said that the economic situation is going to get worse. But the questions we all have is how bad is it going to get and how long it's going to last? Please subscribe and I'll keep you updated.